met Steve Jobs in his t-shirt and black jeans.
Back then, he was just a regular guy, and Apple was just a small computer company and this new emerging, PC industry that a lot of people still didn't really believe in. The same skepticism we see today related to Bitcoin. And we saw it in early days of the internet. We actually saw it in early days of PCs. I remember very clearly a lot of people saying, these things are toys.
Yeah.
What are you going to use it for?
Yeah.
What do you really need this PC for? What happened, though, that really started to catapult the PC forward was the spreadsheet. When suddenly you could do all of these numbers on a personal computer and everyone could have the numbers at their desk, it's like, oh, wow. I've never seen anything like this. It's based on the network. It's based on what other networking companies have done. It's based on Metcalfe's law. Yeah. The thing about the Bitcoin network is that it's now at the stage of its development where it's so set in stone and the mathematics are so strong that I kind of honestly think that the odds of it getting messed up are extremely low. The government's going to be forced to print money because of Keynesianism, and nothing stops this train. So what does that imply? That implies that you want to own things the government can't print. Well, we know the government can't print Bitcoin and can't print gold.
Gold is money. Everything else is credit. By JP Morgan.
Those were the good old days. It did get us from 1789 to 1946 or 1971 or whenever you want to start the decline of America. That wasn't as if we did nothing. We built the best country in the world.
Yeah, no doubt.
Right, on a gold standard. Yeah. So having said that, the gold standard got hijacked and governments abandoned it. And frankly, us gold bugs were fighting a losing battle until you guys came along and provided reinforcements. And so Satoshi created Bitcoin, and I just view it as digital gold. It's a better form of gold, and it's going to outperform gold massively.
Welcome back to another episode of Cypherpunk'd. Today I'm here with my friend Larry Lepard to do episode 9 of our series on his book, The Big Print. We are going to discuss investment implications regarding traditional assets and how Bitcoin may present an asymmetric investing upside bet.
Not may present. It does present.
I love that.
The best one ever.
Well, you and I truly believe that.
Yeah.
You open this chapter talking about, some of your experience when you worked with, I think it was Continental Illinois Bank's venture capital group.
Yeah.
And I guess your mentor or your boss at the time, he kind of said, he quoted him at, "This business is a great business. Easy, really. You can only lose 1x that you invest, and you can make multiples of your money on the upside. So all you have to do is find companies that have a better than even chance of succeeding. Then make the bet. Some will be donuts, but if 50% work and give you multiples of your money, you will be rich." What made me laugh was like a couple of paragraphs later, you're like, yeah, then that bank went bankrupt.
Yeah. Poor John. He worked for the wrong bank.
Yeah.
I mean, that's what I'm describing there is just asymmetry. And, the investment business is a tough business. You're always dealing with uncertainty and it's all based on probabilities. And so the way I've always approached the investment business is to say, anytime you put money at risk, you can lose it. I mean, let's not kid ourselves. Anyone tells you can't is lying. And so if I've got the chance of losing my money, I want to know that if I'm right, if it does work, I'm not just going to make 10%. That's not very exciting with the risk of loss. I want to know that when I'm right, I'm going to make 2 times, 4 times, 5 times, 20 times. And that's asymmetry.
Yeah. I love
and that's the kind of investing that I've pursued in my career. Now, there are others who pursued, value investing in less, where they have less risk of losing money, but they don't have as much upside. And that works for some people as well. But that's not the place I've been.
I'm with you, man. I'm 100% with you. I call it calculated risk. I mean, that's what I like about it, right? So like, what your downside is, but you can make many times the multiple on the upside.
You know that, okay, if I'm going to take this risk and it works, I'm going to make a lot of money.
Wow. I have you quoted here as saying, "Today, after 41 years in the business, I see Bitcoin as the single most asymmetric bet I have ever encountered."
Yeah, I've never seen anything like this. I mean, it's based on the network. It's based on what other networking companies have done. It's based on Metcalfe's law. And it's also based on the fact, and this is a point I like to make, is that, there's really, I mean, I've spent my career investing in companies. Companies have management teams. Management teams are human. Management teams make mistakes. And I've seen really good business ideas screwed up by bad management teams. And it's always a risk. And the thing about the Bitcoin network is that it's now at the stage of its development where it's so set in stone and the mathematics are so strong that I kind of honestly think that the odds of it getting messed up are extremely low when compared to most other things in companies. And in turn, as we mentioned in earlier episodes, the asymmetry of just, the penetration rate is still so low that, as more and more people discover it, that's where I'm absolutely convinced we're going to go to a world where everyone owns Bitcoin, and that's a world where the Bitcoin price is much, much higher than it is today.
This isn't related to Bitcoin, but I saw you pointed out here in your book that you met Steve Jobs in his T-shirt and black jeans. Mm-hmm. Tell me about that. I mean, Steve Jobs is no longer with us, but
no, so my boss was an early investor. He got brought in by the guys at Sequoia to be an early investor in Apple Computer pre-public offering. I think he put $500,000 in it. They took $42 million out, which kind of made my boss a rock star at Continental Illinois Bank, And I think one time before, maybe right after they'd gone public, Jobs came to, I don't know what year Apple went public in, but Jobs came to Chicago, and he came through, and he had lunch with my boss to thank him for making the investment. And my boss introduced him around the office, and I met him, and he was an impressive guy. But back then he was just a regular guy, and Apple was just a small computer company and this new emerging, PC industry that a lot of people still didn't really believe in. It's so funny back then. The same skepticism we see today related to the internet, to Bitcoin. And we saw it in early days of the internet. We actually saw it in early days of PCs. I remember very clearly a lot of people saying, these things are toys. Yeah. What are you going to use it for? Yeah. What do you really need this PC for? Okay, yeah, so it's a word processor. Great. Wang makes those. We have IBM Selectrics. We can type things pretty well. We don't really need a word processor. I mean, then what happened, though, that really, I think, started to catapult the PC forward was the spreadsheet. Lotus 123 was really, which is now Excel, was really a seminal breakthrough in PC productivity. When suddenly you could do all of these numbers on a personal computer, and everyone could have the numbers at their desk. It's like, oh wow, this is different, right? I mean, we can account for everything on this computer. Mm-hmm. So,
I highlighted these two words: tailwinds matter. Unpack that.
Yeah. So, one of the things I think is important when you're trying to look for these asymmetric investments is you want to tailwinds are what I describe as trends running in your favor and being early on in a new trend. I mean, in 1980, if you believed that inflation was going to go down, you had a deflationary tailwind for 40 years. When the internet came into being in 1993 and more commercial in 95 to 2000, you had a tailwind of adoption. In Bitcoin right now, we have a tailwind of adoption. I think we have an inflationary, based on the way the government's behaving and the deficits they're running, fiscal irresponsibility, I think we have an inflation tailwind right now. So I guess what I'm trying to say there is you want to find the big thing that's occurring, but you want to find it closer to the early part of the trend, not the later part of the trend. I mean, let's just look at it like in an industry, for example. I mean, investing in the automobile industry in the 20s, if you pick the right names, or 30s or 40s or 50s or 60s, as the world was going from nobody had a car to everyone had three cars, was a great place to be.
Huge tailwinds.
Well, big tailwinds, right? Adoption. But, right now, pretty much everyone who has a car needs a car, has a car. And the automobile industry is not really growing much. It's a mature industry. And so I guess the thing about venture capital, about asymmetric investing, I've always tried to find is I want to find some societal trend when it has proven that it's real. There are dogs eating the food, right? But only a few dogs are at the party.
Yeah,
and more dogs are coming. Is I guess the way I would put it.
I like that analogy. It's felt like we've had headwinds, for the past couple of years, with government policies and all sorts of stuff. Well,
yes, we've had that.
That has really flipped to tailwinds in the past.
Yeah, right. I mean, that was always the big concern. The government's going to shut this thing down. Now we got an ETF and a strategic reserve. Big deal.
Yeah, the tailwinds have been changing.
Yeah,
it's just interesting to look at history and look at these different time periods where, you did point this out. The market's obsession with past inflation, right? Like you said, the 80s from the 70s has blinded it to the dawn of a new era, a 40-year deflationary supercycle, a cycle driven by a combination of falling deficits, no Vietnam War, technological advances, globalization, and offshoring cheap labor from countries like China. Few recognize that Fed Chairman Volcker's rate hikes had crushed inflation. Another thing you pointed out is this idea of a PE ratio. I've heard this many times. People talk about it. Do you want to explain that in layman's terms for people so they can kind of understand that?
Sure.
I found your definition. I can read your definition after you explain it, but I just found it really
hard to understand.
No. The way that you explained it in your sub notes, I thought was like, wow, this is the best way I've ever seen it explained.
So when anybody looks at a stock, Are you going to buy this stock or not? One question you might ask, you look at the company, say, this is a good company. I like their products. It's growing. People like it. Okay, I want to be involved with this company. That's one thing you do, your qualitative test. The second test is it cheap or is it expensive? How much? Okay, fine. When you buy a company, what you are doing is you're buying a fractional share of that company. And so the price to earnings ratio is the price of the stock, because your piece of the company you own is represented by that price. And the earnings is the amount that the company earns relative to that piece. So let's keep the math really simple. If you pay $10 for a stock, you're paying $10 per share. And if the company earns, millions and millions of dollars, but has a certain number of shares outstanding, so that when divided, the earnings divided by the number of shares gives you $1, you're basically you're paying $10 for a company that makes $1 a year. And so just on an earnings yield basis, that represents a 10% earnings yield. Okay. And if they were to pay it all out in dividends, you'd be getting a 10% yield on the money that you invested. And so that's your most common measure of stock valuation. Now, let's talk about long-term historical averages. The long-term average PE ratio for stocks is 14, implying yields of, stock yields of about 7%. But the range is very large. There are times when stock average PE yields have been as low as 5 or 6% when we're in a big bear market. And there are other times when they're as high as 22, 24, 25%. Sometimes even higher, 30 or 40%. And right now, just as an example for a data point, the S&P 500 today is trading at about 21 times earnings, which is on the higher end of the range.
Yeah, in the book here, you said the S&P is 29.6 times earnings.
Right, I think it's come down a little bit.
Okay.
A little bit, yeah.
Right, back to reality a little bit.
Yeah.
This is all a symptom of what I call the everything bubble. Interesting. We'll unpack that a little bit later on too. This 30-year Treasury yield chart, can you explain this a little bit in your book? You show here that we reached an astonishingly low level of 1.01%, essentially in March 2020. That moment marked peak deflation.
Right. So
essentially, that was the end of this 40-year cycle. And now you're thinking that
I think the cycle has turned, and we're back in an inflationary environment given COVID and all the spending they did. Yes. So as we know, there was a lot of inflation in the 70s. Paul Volcker crushed it in 1980 with 20% interest rates. But it took time. There were times in the 80s when the interest rates were still 7-8% because everyone feared inflation would come back. One of the things investors tend to do is they look in the rearview mirror. They say, what happened recently? Okay, that's going to happen again. And what many people missed was that inflation really wasn't going to come back. We had this deflationary trend. And so we went from a 10-year yield. I don't have the chart right in front of me, but at its peak, it was quite high. And over that 30-year period, 40-year period, it decreased because there was really they were underreporting inflation, and investors weren't looking out for inflation protection. And that cracked with the COVID example. It's interesting, as you maybe recall, there was a period of time remember the Fed in the 2015, 16, 17 period, they were saying we've got a real problem, inflation's too low, which it's kind of hard to believe, but I mean, there's no such thing in my mind, but that's what they were saying. They had a mandate of 2% and it was like 1 or 0% or 1%. Yeah.
You know what? I actually do vaguely remember hearing some of this stuff way back then. I mean, I was still high school, college. I didn't really kind of understand a lot what's going on, but I do vaguely remember reading the Wall Street Journal or seeing something like, what is this? Kind of but not understanding.
Yeah, we're not fulfilling our dual mandate of having some inflation. I mean, they had defined, because they were fearing deflation, they wanted to make sure they had 2% inflation.
Yeah, I think I might have just had learned about Bitcoin at this point and didn't quite understand all the implications of everything. And it took years to kind of really get a grasp of everything. What about stuff like AI, right? So do you think that those things are
those are very deflationary things, and there's a lot of deflation still taking place in the technology sphere. Okay, and I don't. Once we return to sound money, I think we'll have a deflationary world again. But keep in mind that we know the Fed's third mandate is keep the financial system running.
Yeah.
And we know that they can't keep the financial system running if they don't have inflation. And so what I believe, and this is, of course, the title of the book, is that they're going to be forced to print, and that will create the inflation. So I think we now live, because of that construct, I think we live, at least for a period of time, in an inflationary world until we solve this money issue, a sound money issue.
The new tailwind will elevate assets that benefit from monetary inflation, which, as we discussed earlier, is nearly a mathematical certainty if we wish to keep the economy functioning.
Right.
You say here that you believe we are in the midst of a sovereign debt crisis.
I do, yeah.
Unpack that a little bit.
Well, we talked about it earlier. It's a little bit of just the Stein's law. I mean, recall that, COVID came along. We increased spending 30-odd%. We never went back.
Mm-hmm. Yeah.
Deficits, that used to be considered outrageous have now become normal. I mean, we did a $1.8 trillion deficit that last year. We're running at well over 2, maybe in the low to mid 2s this year. And in spite of Doge, and the attempts of Doge and the fact that they will probably be able to eliminate $100 or $200 billion of expenses, that's not 2.3 billion or trillion that we're running in deficits. And so, I believe that we are going to continue to spend more than we take in, and that's going to force them into printing to cover that spending.
So, would you recommend certificates of confiscation as a sound investment?
Yeah, no, I would not. That's funny. That Henry Kaufman was this brilliant economist at Salomon Brothers back in the day in the 80s. And, you have to remember in the 70s, bondholders got destroyed. I mean, there was so much inflation.
Yeah.
And so Kaufman was an economist, and he came out and he labeled the U.S. Treasury bond was a certificate of confiscation.
Oh, that's classic.
Actually, I think James Grant said the same thing. So
classic.
Yeah.
Let's talk a little bit about real estate. I know this has been a central thing that many Bitcoiners intuitively understand, that this asset has been monetized, and it's been to the detriment of majority of society.
Yeah, it has. Yeah, that's why kids can't afford houses.
Yeah. My generation 100% gets
it. Boomers store a lot of their wealth in real estate. It's not a good place to store your wealth, in my opinion. I mean, so let's just go back and zoom out to the big picture, okay? The big picture is the government's going to be forced to print money because of Keynesianism, and nothing stops this train. So what does that imply? That implies that you want to own things the government can't print. Mm-hmm. Well, we know the government can't print Bitcoin and can't print gold. The government also can't print houses. Mm-hmm. Houses, I mean, there are many problems with houses, but the one good thing is you can live in them. They have utility, and there's a fixed supply of them, although they can build more. Mm-hmm. But and land, they're not making any more of that.
But there's a real proof of work that's required to build a house.
Exactly. It's a physical asset. It's a legitimate physical asset that can't be conjured with a keystroke on a computer like fiat money. So for that reason, it's not insane to think about storing wealth in something that's physical as opposed to other things like bonds, which are terrible. But I also point out that it has real drawbacks. I mean, you can't move it. You pay taxes on it. And by the way, property taxes are going up very rapidly because all governments need money. And also, use cases can change. I mean, a very good example of how real estate hasn't worked out very well for some people is commercial real estate, right? So, back when we were all going to the office and the internet didn't exist and we didn't have Zoom, we needed a lot of buildings where we could put people in cubicles and have them do their work. Yeah. Well, guess what? The internet and Zoom changed all of that. And so now you're seeing very large office buildings that are literally selling for, 10 to 20% of their last sale price. All the value has come out of them. Right?
I knew something was seriously wrong about 3 years ago, when I was looking for a new office, and I'm going around Naples and looking at these buildings, and my
what was happening? The rates were low?
Well, I told my assistant at the time, I mean, I was looking to just kind of rent a place probably, or potentially, I mean, we were looking, depending on the right deal, to buy a place. Sure. And I'm just going to these buildings and they're all empty. And I see the quote of the price of the thing. I'm like, I look at it and it's like, oh, it's $5,000 a month for this. And it's like, I look at the whole building, it's completely empty, not a single person on this floor. And I'm like, I'm going to offer a little bit less than that.
Maybe a third.
Maybe half that. Because there's literally nobody here.
And did they hit you?
No. Well, I guess what I was trying to figure out was, you've got nothing. This has been, and I would wait a couple months and come back and there's still nothing. And I'm like, hey, you don't really have any other offers here.
They were in denial.
Why don't we, why don't you
cut a deal?
Why don't you cut a deal, right? Why don't you want to negotiate here? It just doesn't make sense to me. Yeah. And then I finally figured out that the reason they weren't doing it,
I know what you're saying,
is because they're playing these financial wizardry games where they need to keep, if they would accept my offer, it would reduce the value, the paper value of the building, so they couldn't, play the financial game.
Exactly. So they probably had a loan against the building.
Yeah.
And when they accepted your offer, the bank would say, "Oh my goodness, this isn't worth what we thought it's worth, and we're not going to roll this loan over."
Oh my goodness! I mean, that to me is insane.
Yeah. So they would actually rather eat the loss and let the building sit empty then recognize it and have the loan called.
I knew when I understood that and heard that, I was like, something is seriously wrong here, and there's going to be problems. And then sure enough, like a year and a half later, boom, commercial real estate, huge problems. I'm like, this is just these games, these wizardry games. I mean, it just blows my mind. Like this can happen like that, that those are the incentives. The incentive system is completely broken, right?
Right. And the fact is there is a lot of monetary premium in real estate because a lot of boomers and others have stored their wealth in real estate. What I find very interesting is I wonder to myself, who are these boomers going to sell these houses to? Because I know my millennial kids, they don't want a big house. They view that as a burden. And I think in general, millennials and Z and others they're much more into being able to travel and have freedom and they're not going to measure. I mean, boomers, houses are a status symbol for boomers.
Yeah.
And I don't think houses are going to be as big a status symbol for the next couple of generations. And so I think there's just, there's a crash waiting to happen in some of these high-priced houses.
I think you're not. I don't think you're wrong. I don't think you're wrong. I touched on this with Dominic Frisby in his book, but, property for when under the gold standard is like property values went up a very small amount every year. And then all of a sudden, like
it crashed.
It's just, insane. Like over like a 1,300 year period, like housing values went up so small every year where like it would, they would go up, but like, so not to the point where like you're priced out of a house, but like as soon as we moved away from a gold standard, there's all these other incentives and perverse incentives. And real estate became a place where people stored wealth. It obtained a monetary premium, which has all these other knock-on effects. Right. And it was just striking to see the difference in that, like where it went from like 0.24% a year to like 12% a year every year for 100. You know what I mean? It was just crazy. It was wild. The other issue that you mentioned, and luckily we live in the state of Florida, and I don't know if you saw this from DeSantis yesterday. He goes, "We're going to work to eliminate property taxes in Florida."
Are you serious?
He said that. Yeah, he said like that's what their goal is.
I'm all for that, but I don't know how they're going to do it.
Yeah. So you mentioned this as a major cause for concern with real estate, right? The idea of property taxes, because you don't really, which is kind of true, is like you don't really own it free and clear, because local municipalities and states have a first claim on your real estate in the form of property taxes.
Yeah, you don't pay the property tax, they're going to take your house.
Yeah. So there's that absolute thing, right? So there's that risk, a factor of it, with. If you live in a state like California, New York, where the terrible budget management.
Well, that's the thing. It's very state by state. I mean, one of the benefits of Florida, as you know, is you can homestead your house, and then the property tax increases get capped at a more reasonable rate.
Yeah. I
mean, the thing it's just eaten us alive. And I know I lived in a larger house in the Massachusetts area where I raised my kids. I could not believe how much my property taxes went up over the period I was there. It was awful.
I was going to buy, in New York because I have family there, and like I was looking at buying at like a lake house or something. And I was honestly shocked because I got the quote on the house and I look at the property tax bill and I was like, this, like, I look at the thing like, oh, this isn't too bad, And that's like not a bad monthly payment for property taxes and stuff on the thing, or not a bad yearly payment for property taxes.
It was a month.
It was a monthly payment. So the realtor's like, no, that's your monthly payment. I just started laughing. I said, like, is this a joke or is this serious? Right? Because I live in Florida, obviously, and it's like 10 to 20, it's like 10 to 12 times
much higher.
It's insane.
Yeah.
How do people do that?
I don't know. I mean, it's these big states. I mean,
unbelievable.
California, Illinois, Massachusetts, New Jersey, New York, they're all terrible.
Unbelievable. I mean, how do they get away with that? That is unbelievable.
And what you're seeing is you're seeing an exodus from those states.
Oh my!
I mean, this is why people are going to Florida and the Carolinas and Texas and other places because it's just too expensive.
We've talked a little bit about real estate, but let's talk a little bit about stocks now.
Sure.
My whole life, I've grown up in this environment of stocks where it just seems like it's up forever almost.
Buy the dip.
Buy the dip, right?
Yeah, it works.
Stocks represent ownership in business enterprises, and when those businesses are healthy and growing, they can provide great returns. That's what you annotated here in your book. While these figures are impressive, it's important to note that stock returns are largely driven by underlying monetary inflation and are not immune to sharp drawdowns. You have a graph that you show here, and like once you kind of see this, it's like stepping outside the matrix, right?
A little bit.
Like you look at these graphs, and you're accustomed to see this, but what it doesn't take into account is all the asset inflation that's actually happening here.
Right.
I know earlier we talked about like Zimbabwe stock market when the currency's hyperinflating, the stock market returns are through the roof, right? It's like up 1,000% this month or 2,000, whatever it is. So the key aspect I think you highlight here in this chapter is that stock returns are largely driven by the underlying monetary inflation, right? So looking at this chart, you put the S&P 500 returns with and without inflation. I mean, it's like night and day difference.
Yeah, right.
Oh man, like a 5,000% difference, I think, on the chart you show here. What are your thoughts on all this?
Well, as we know that when you have massive inflation in stock or in the currency, everything that has some value goes up. Real estate goes up, gold goes up, silver goes up, et cetera. And the stocks, as I say, they represent a claim on the earnings power of businesses. And the Zimbabwe stock market did very well. The Venezuelan stock market did well. The Weimar stock market did really well. Again, back to this. Now we go back to nominal and real, and that's just because the stocks represent a claim on the earnings of the business. Now, what happened in all those cases is the currency failed, and if you held onto the stock and the currency got repriced and the business survived, you probably came out the other side okay, because you still owned a piece of a company. Yeah. Companies have value, but it's risky. I mean, companies in hyperinflation, some companies fail, and if you actually looked at the returns in all three of those cases in real terms, in other words, if you adjusted the stock price for the depreciation of the currency, they were just barely keeping even. So you didn't really make any money investing in stocks in high inflation. And I guess the other important point about the stock market, you mentioned in the beginning how we talked about how it's been nothing but buy the dip. And so I think there's a whole generation of investors are kind of conditioned to the stock market only goes one way that's up.
That's been my whole life. I mean, pretty much. I mean, there's a great financial crisis and stuff comes down a little bit. And like,
it came down a lot. It came down 50%. But and that's .com.
But like once you're a Bitcoiner, you're like, when you've been in crypto, it's like, people are like, the sky is falling. And you see the stock market's down like 8%. It's like, what? I can't even notice this. Like,
because we're used to bigger volatility. I guess the point I'm trying to make is that bear markets have not been outlawed, and we've had bear markets in the past. I mean, and there used to be a whole category of people called short sellers. There were actually famous short selling firms in the 70s and 80s and 90s, and they did pretty well. When you're in an environment where the government will not, one of the policy objectives, we talked about this earlier, Greenspan kind of almost made a policy objective.
The third policy objective of the Fed.
Not let the stock market fall. They've achieved their objective. Now they've achieved it via inflation, but they have achieved it. And so it makes shorting stocks a very dangerous proposition because, we know that the Fed is not going to let stocks go down too much. Having said all that, if the Fed loses control and or if financial conditions really change to the point, and we do have a big economic downturn, the stocks today are at very, very high price earnings multiples and represent, in my view, a fairly substantial risk. And when I look around at my cohorts, many of them are boomers and many of them have a lot of stocks. And they've gotten rich off of those and they don't want to sell them because they've worked. But I think there's a chance that they're setting themselves up for a nasty surprise because I do believe that bear markets have not been outlawed and that we could have another one at some point.
There's also the fact of like just stocks in general and then certain companies that are kind of, generational companies that.
Well, that's right. Some stocks are a lot better than other stocks. I think I noticed this in the book and I think it's a really important thing. And I observed it over time. And actually when I was writing the book, it kind of jumped out at me when I did the math. The stocks of some of these internet-oriented businesses have just been unbelievable. I mean, the whole Metcalfe's law.
Yeah, we're going to talk about this actually.
Oh, are we coming to this? Okay.
Well, I wanted to because I have actually a really important question to ask you about.
We'll get to that.
Looking at your standard.
But I guess the point is that if you're in the right stocks,
that's the key.
You can really do extraordinarily well.
Yeah.
That's tricky because you got to know what the right stocks are.
True. I think MicroStrategy is a good stock. What do you think?
I love MicroStrategy.
Or Strategy B, as they're known now.
Yeah, it's a fantastic stock.
I know. It's just like it's made my portfolio returns just look insane.
Yeah, it is really. I mean, what Saylor's doing is just brilliant. It's absolutely brilliant.
Oh man. So the Austrian school actually has a term for what we described with the stock market with inflation. It's called a crack up boom.
Yes,
I love it.
Yeah, and crack up boom is defined as when there's so much money that literally the price of everything will go up because everyone's anxious to get rid of the money.
Yeah,
nobody wants to hold the cash.
Yeah,
they got to buy something else.
Yeah,
and that could be property, it could be stocks, it could be gold, it could be anything.
One other question I had for you, we kind of talked about this, how the Fed has conditioned, at least my generation is like buy the dip. Anytime it goes down, it's like, oh, stuff's on sale, right?
Right.
I think stuff may be on sale, but you got to pick the right stuff, right?
That's right.
So you wrote, investors think they have figured this game out and nothing can ever go wrong. very few investors recognize that macro conditions have changed and that we hit peak deflation in March 2020. We now live in an inflationary world, meaning stocks will perform differently. So very interesting take there. The other question I had, the one question I had was a carry trade. You talk about a carry trade. Can you explain that a little bit for the listeners?
Sure. Let's go through the first part though, because I just think it's a very important point to be made.
Riff, go for it.
The decade today is going to look like the decade of the 70s, and in the decade of the 70s, stocks kind of went up and down and up and down and up and down, and by the end of the decade, you hadn't made much money at all. So it was kind of dead money, and you had some pretty big drawdowns during that period. And that's because inflation squeezed profit margins and everything else. I think we're in an inflationary world now. I think profit margins are going to get squeezed, and while stocks may not go down, I don't think they're going to go up the way they have gone up when we were in a deflationary. Okay. But go ahead. State the question again that you had asked on the carry trade, right?
Yeah, I was just curious about a carry trade.
Yeah.
I've heard this used many times.
So this is what Wall Street does. This is what everybody does, and this is what quintillionaires do.
Yeah.
The carry trade, by definition, implies that you borrow money somewhere where it's cheap. You know, like and people were doing this with the Japanese yen because the yen had very low interest rates. But you borrow money somewhere where it's cheap. You take the money and you place it in something where you can earn a much higher yield than your cost of borrowing. And so you're getting a carry. In other words, without doing anything other than making that trade, you're earning a lot on your capital. And particularly if there's a lot of leverage involved, it can be, even if the yield isn't much higher than the cost, if you use enough leverage, you can jack that yield up.
Yeah.
And so this is what's created the everything bubble. I mean, when we had ZIRP, we had ZIRP from 2009 to 2015, then we had it again from 2019 to 2022. All kinds of financial actors, hedge funds, PE firms, et cetera, went out and borrowed money really, really cheap, and they invested it in things that were growing and that had yield. And guess what? They got rich. It works.
Yeah.
Now but the problem is it works in reverse. If the money gets more expensive, then they've got to unwind the trade, and we've recently had more expensive money, and it's caused some distress for some of these people who are playing the carry trade game.
Yeah. Next, you show this chart where it kind of shows the historical trend line of stocks over the past almost 100 years, maybe 80 years, 70 years. And it shows that the standard deviations, the historical trend line, and then the standard deviations of, market prices of the stock market, how inflated it is over time. It's showing right now that we're currently above that second standard deviation line.
Yeah, it's at the Buffett indicator chart.
Yeah, the Buffett indicator chart. The only thing that I can see here that throws a wrench into this is like thinking about Metcalfe's law in some of these equities and investments, like AI stuff and social media networks and Bitcoin. Is another example, but like has the game changed a little bit here? Like, can we? Yeah,
yes and no. I think for general stocks, the old metrics will apply. I think what you're pointing out is that there will be exceptions to the rule. And actually, just like in the 70s, there were exceptions to the rule. You know what the two best performing stock categories were in the 70s?
No.
Gold mining stocks and oil stocks. Why? Because the price of gold went up a lot and the price of oil went up a lot. So in this particular cycle, what I think will be, will outperform. The stock market could go sideways, and yet I believe that internet-related things and Bitcoin-related things will crush the market.
Yeah.
Because they're both in big macro trends that are going to continue.
Yeah. Interesting. So, what about the rest of the Mag 7 stuff?
It depends on what it is. If it's got a network component, I mean, one of the things I point out, I think a little later in that chapter, is just how well these networking businesses have done. I mean, if you invested in Facebook or Google or Apple, which is kind of a network because they've got all the apps tied into it, or any other internet-based business, Amazon, the returns have just been stunning in the past 25 years. In other words, we've never even seen returns like that anywhere else. I mean, if you invest in General Motors, which is a very successful automobile company in the 20s, and rode it to the day, maybe you'd have made 60 to 70 times your money. I did the math on it once. But if you look today at what you've made, I mean, Amazon's up 218,000% since it went public.
Yeah,
I mean,
it's wild. It reminds me of Bitcoin in a lot of ways. I mean, looking at the charts of when initially Bitcoin had gone up from something to almost like $100, and then the crash was like 95%. It went down to like $4 or $5.
Right.
And like if you really truly understood what Amazon was doing and what they were and how they could be successful, and you bought there, it's like now it just went. It's crazy.
It just kept on going. Yeah. And so So, networking businesses are different, and they've broken the traditional investment model. The traditional investment model was, you looked at things on a PE basis, a price to book basis, and made valuations. Networks grow as Metcalfe's law states, networks grow at some compound power function, either a square or some other number, but it's a geometric growth with the growth of the network. And a network is an extremely defensible business because, once people are using, everyone uses Google because everyone uses Google. People want to advertise on Google, and then people want to search on Google because it's the biggest. And so that kind of a thing, makes, and so the same will be true with Bitcoin. It is a network business, or it has a network effect in terms of its monetary.
Yeah, money is the biggest network that all humans use.
Exactly.
It's unbelievable.
Yeah, and so it's gonna continue to perform extremely well in my view.
You have a chart here from somebody named John Hussman.
Yeah.
He, I guess he has a valuation model that ties market value to corporate earnings power. You wrote here that currently this is the most negative return estimate he's ever calculated.
Yeah. The stock market is very overvalued, in my opinion, particularly when you factor in the fact that we are no longer in a deflationary world and that money isn't necessarily cheap anymore.
Wow. Yeah,
So I think one of the things I tried to do with this book was to shock some boomers into realizing, hey, if I've got my entire retirement in the stock market, maybe that's not the smartest thing to do. Now, fine, you believe in stocks, and you got the right names, you want to stay there. Okay, that's fine. But what I would suggest to you is that in given the likely monetary debasement that we all see coming, to be 100% stocks and nothing in Bitcoin or nothing in gold, that's not optimal.
Yeah, that's it just doesn't make sense.
It doesn't make any sense because stocks are fully
There's
priced.
no risk,
you're not getting
zero risk management.
Again, it goes back to what I said earlier. You look at a company and say, is this a good company? Then you look at the company and say, what am I paying for it? And that's the problem I have with the stock market. The stock market is a good place to be.
A lot of people never ask that second question. I think is a very important question.
Exactly.
So the key point I'm getting from this is stocks do well when inflation is low. And this is what you wrote, while commodities underperform. In turn, commodities do well when inflation is high while stocks underperform.
Right.
I think, again, you can't get... I go back a couple of pages to the chart that you have.
It's a good chart that shows how it swings back and forth, right?
Yeah.
Isn't that something?
Yeah. But kind of showing this long-term trend, Gary Tanashian, where he's got, the 30 treasury. It's just, we've reached this point of it's so low, that
interest rates they're not going to go negative.
It kind of broke that.
They did in Europe, but not for long.
It broke that monthly, EMA, that moving average. And it's kind of confirmed that breakage, and once you hit the bottom, once you drop the ball at the bottom, the ball has to bounce back.
You got nowhere to go but up.
How high will it bounce? We don't know. But it can't go further than the ground.
Given that nothing stops this train, it feels like it could be pretty high.
Yeah, that's a good point. Yeah, and then this one's really cool. This commodity index. This is a great quote by J.P. Morgan. Gold is money. Everything else is credit.
Yeah. Those were the good old days.
So let's talk a little bit about gold. This old world
analog sound money.
This analog sound money.
That some Bitcoiners hate, but they shouldn't.
Yeah, I don't understand that. I love gold. I just I love Bitcoin.
Bitcoin's better.
Way more.
Bitcoin's just better.
I think it's cool. Yeah. One of gold's defining attributes is its lack of counterparty risk. It's nobody else's liability. Until Bitcoin, gold was unique among all financial assets. It requires no intermediary, no promise of repayment, and no system of trust. It is final settlement. It is also a bearer instrument.
Right.
You got some other great quotes here. Gold is money. Mankind has chosen it as money for thousands of years. What are your thoughts here on gold?
Well, until Bitcoin came along, it was the best form of money we had. It was flawed because it dilutes at 1.7% a year.
Yeah.
But that was all we had. And frankly, people who shit on it, I think, are wrong in that it did get us from 1789 to 1946 or 1971 or whenever you want to start the decline of America. That wasn't as if we did nothing. We built the best country in the world.
Yeah, no doubt.
Right, on a gold standard. Yeah. So having said that, it got the gold standard got hijacked and governments abandoned it, and frankly, us gold bugs were fighting a losing battle until you guys came along and provided reinforcements, and so Satoshi created Bitcoin, and I just view it as digital gold. And it's a better form of gold, and it's going to outperform gold massively. Like I've said it several times in other podcasts. 70% of my net worth is in Bitcoin. The balance is in gold.
Yeah.
Everyone has a decision to make. on how much volatility. I mean, if you're gonna bet on sound money, those are your two choices. And what I would suggest to everybody, and I do this to my clients, is you weight them based on your tolerance for risk. And I have very old clients who don't want much volatility, and so they're going to be more gold weighted. And I have younger clients who want aggressive alpha, and they don't care about gold. They have nothing but Bitcoin, and that's great. They should have nothing but Bitcoin. So, gold didn't. The thing to remember about gold has no earnings, just as Bitcoin has no earnings. It's just an asset. But it actually kind of did its job. When we were on a gold standard, it actually kind of did its job. If you look even post going off the gold standard, I mean, monetary inflation since the early 70s, since 71, has averaged in the high 7s, low 8%, and gold has appreciated in the high 7s, low 8%. So, as you said earlier, that 1 ounce of gold still buys a suit, and it did in Roman times. So it's money that does hold its value.
It functions as a proxy for value preservation.
Yeah, when compared to fiat currency, that's great. It's better than fiat.
No doubt.
Yeah.
Here you wrote, banks began to transfer gold electronically using ledgers to keep score without the inconvenience of physical shipment. Another example of money being a ledger. It was this shift in convenience that ultimately facilitated fractional reserve banking. So I think that was an attack vector for gold.
Absolutely.
Flaws
there's a lot of flaws with gold. You don't know who has what, where it is, if it's pure, all kinds of things wrong with it.
Here we wrote about Nixon closed the gold exchange window and decoupled the dollar from gold. Severing the dollar's last tie to gold marked the third monetary default in U.S. history. The first was the hyperinflation of the Continental. The second was the Civil War era and the Legal Tender Act, which established the greenback. And then the third now is this final huge blow. Yeah, I mean, it depends on the economy. You can also kind of count Roosevelt's devaluation as another one. So there are 3 or 4. Yeah. These are some interesting charts where you overlaid gold and stocks to really kind of weight the performance and see how they performed. I mean, it's gold, everyone really, a lot of stock guys shit on gold. Yeah. It's actually done okay versus stocks. Yeah. It's not as bad as you think. No doubt. I'm looking at it right now. It's not that bad at all. Stockbrokers obviously don't make any money selling gold, and therefore they shit on gold. Right. How does Peter Schiff make his money when he's selling? Oh God, I don't know what he does. Peter's, I can't imagine. He's so bright as an Austrian economist, and he's so wrong about everything else. I just don't get it. I don't get. I mean, he's kind of a mystery to me. You think he's just playing the game still? No, I don't. I think he actually legitimately believes it. I've been on conferences with him. I've looked at him. I think he's the guy who heard about Bitcoin really early, and is just kicking himself. He's getting it now, though. Like, he opened up his Bitcoin strategic reserve. People have been sending him Bitcoin. Oh, really? I didn't know that. I've been watching. I wasn't aware of that. But I think I think he's the guy who just is so butthurt that he missed it, that he can't change his view. Yeah. And it's kind of sad because he's got all the rest of it right in terms of Austrian thought. Here you wrote, the terrorist attacks of 9/11 kicked off another war cycle, and the U.S. has spent over $8 trillion fighting wars since 2001. I don't think it is a coincidence that monetary debasement accelerated when such a large portion of government resources were funneled into an unproductive activity. Right. Yeah, I mean, think about it. Yeah. The important thing for people to understand about gold is that historically, gold has held governments to account, right? Like that's kind of forcing fiscal and monetary restraint. Obviously, they didn't like that. No, they don't like that. Obviously, we look at these attempts to devalue, and obviously Roosevelt did his thing, and FDR did his thing, and then till we get to 1971, it really fully we've got this accountability. At that point in time, all restraint was lost. Yes. In the words of John Maynard Keynes, gold is a barbarous relic. Yeah. Let's see here. The maestro. So I didn't know Alan Greenspan. You wrote here that he has he's patient zero for the inflation virus, but he was an early follower of Ayn Rand. Yeah. He was a gold bug back in the day. Isn't that amazing? Yeah, that is wild. This was before his ego craved the glory of being a central banker, and he was dubbed the maestro. Yeah, Bob Woodward wrote a book titled The Maestro about his whole thing. Oh yeah. Notice how these guys, they all celebrate themselves. Yeah, right? the news articles and the books. I think you have Vernaculator. The hero. And it's no surprise it's written by The Atlantic. Yeah, right. Very progressive liberal. Yeah. He's he saved the world, as they said in this picture. Like the committee to save the world. Why is everybody upset? This guy saved the world. Yes, exactly. Oh man, it's like a picture of Charles Ponzi and say, why is everybody upset? This guy's
the big deal?
This guy's a great investor.
Yeah.
But you wrote here, before rising to Fed chair and becoming a serial inflator. Oh my goodness. But then you quoted him, in the absence of the gold standard, there is no way to protect savings from confiscation through inflation. There is no safe store of value. Boy, have times changed for him.
Yeah, right.
We keep coming back to this idea, and we talk a little bit here about Volcker and Nixon. And again, this was well before I was born, so I'm like learning about all this stuff and really trying to understand it all. You've kind of said that he should have just devalued the dollar, let gold and all currencies float independently, and thereby created a true neutral reserve currency that provided numeraire. That's an interesting term, a numeraire, which you wrote is the term for the base unit of account of a currency system. So what... If that happens, can you explain how that solves the Triffin's dilemma?
Yeah,
if it just kind of floats.
If everybody settles in a neutral reserve asset, then there is no reserve currency per se.
Yeah.
And the fact that we had the dollar tied to gold and all the other currencies were linked to the dollar at a 1% parity off of the dollar's value, that's what created the problem. And so we had to run trade deficits in order to keep the world liquid. If we had gone back to the gold standard and let the dollar float in terms of gold, and say, we're going to now trade. If you have trade deficits, we settle in gold. Which, by the way, that's kind of where the world is going right now.
Yeah,
I mean, you're starting to see Russia and China and the BRICS are all trading with each other and each other's currencies, and
they've been doing settlements in Bitcoin too. Did you know that?
I wasn't aware of that, but
the Russian central bank, I think, and a couple other of those
wouldn't surprise me.
They've publicly come out and say that they've been doing settlements.
It wouldn't surprise me. It makes perfect sense that would be happening, and so we've seen the exchange or the volumes on the Shanghai Gold Exchange go up substantially because what's happening is people are getting paid, in yuan. Say that Saudis are getting paid in yuan, and then they are in turn converting that yuan into gold through that exchange.
Why don't you want to go ahead and just define the Triffin dilemma? Because most people probably have never even heard of that. Like I didn't until I learned about Bitcoin, and I had never even heard of the Triffin's dilemma. I think Bob Burnett told it to me 4 or 5 years ago. He explained it to me.
Yeah. So here's the problem. I think we might have talked about it a little bit when we talked
touched on
about Bretton Woods, but basically Triffin's dilemma says if you have the world's reserve currency, which Bretton Woods set up the dollar as the world's reserve currency linked to gold, and they left the gold piece in there because they knew that they needed gold as a stable anchor for monetary volume. If you do that and you say that the dollar is the world's reserve currency, well, then how do other countries have enough dollars? They don't have enough dollars unless they run a trade deficit with you. And this is a little bit confusing, but we run a trade deficit with them, which is to say we buy more things from them than they buy from us. So, France will produce wine and send it to us, and we pay for it with dollars, and that gives the French dollars, which they need both to buy things from us and to keep their system liquid. And so structurally, a country needs to run, the world reserve currency needs to run a trade deficit. And then that deficit, by the way, gets recycled back in terms of a capital account surplus where they invest their money in dollars. And this goes to the petrodollar. I mean, when we went off the gold standard, Henry Kissinger quickly got on the plane, went to Saudi Arabia and said, look, we're going to do a deal with you. We're going to tell you that you can only sell oil priced in dollars, and we're going to send you dollars for the oil that you sell to us. But in turn, as a result, and we're going to give you protection, we're going to give you military protection against any threats. But in return, what you're going to do is all those dollars you receive from us, you're going to use them to buy our treasury bills.
Brilliant.
And so so it was a brilliant, it created the petrodollar. So it was kind of a brilliant system that allowed us to live beyond our means. And in doing that, what happens is the dollar becomes overvalued relative to other currencies. And so as a result, we can export our inflation and we get to buy goods cheap, which is, I always wondered this when I was younger, like, why do Americans live so much better than everybody else in the world? I mean, we're a great country for sure, but it's kind of like, our standard of living is just higher than everybody else's. And if you really look at it carefully, the reason for that is because of the supremacy of the dollar and the fact that we're kind of, it's what the French called an exorbitant privilege of we can actually print paper, send it to foreigners and get their goods. They've got to work hard and sell their goods to us in order to have our currency.
This is kind of the counter argument to globalization and kind of saying, well, we're suffering. The manufacturing base is suffering, but we've got this exorbitant privilege.
Well, and at the time, I remember a lot of people were saying, well, who cares if other people are willing to sell us goods on the cheap? In fact, when we let China into the World Trade Organization, the whole notion was, well, look, if they want to sell us cheap stuff, what's wrong with that? We get cheap stuff. Okay, fine, but think a few years ahead. Suddenly, we stop making things.
Yeah.
And then, COVID comes along and you realize you don't have mask makers anymore. And you realize you don't have pharmaceutical companies making things. It's all made in China.
Yeah, it becomes a national security issue. And I think that's, aside from anything else, when it comes to tariffs and all that, I mean, the libertarian argument is great, but the government actually does have one job in my mind, to protect, to provide national security.
Correct.
That is their one job. So, some level of tariff that they can use, which it is a tax, but to do their one job, which is make sure we have national security, make sure if there's a pandemic, we can make masks and medicine, make sure that if there's a war, we can make, bullets and guns to protect ourselves. Drones, for example, like that's the future of war. Like we don't have that here. We don't have any domestic. I mean, so I think this is kind of what Trump is striking at. There's got to be some level of balance here.
Oh, absolutely.
Right? Like we got to have some.
And I think what happened is in D.C. there was a realization that, oh my goodness, I mean, even Yellen recently said it. There's a limit to how much of this globalization we can do, and it's strategically dangerous.
Exactly, it is strategically dangerous
because we don't want to live under. I don't want to live under a Chinese communist system.
Yeah, and this was what I like. You learn about. I mean, this is not new historically in history.
Right.
When I did the series with Dominic Frisby, one of the main chapters, one of the best chapters of his book was about the Civil War and like kind of how all that played out. But at the beginning of it was the United States as a whole came to this realization after the War of 1812. They realized, holy fuck, we don't make anything here, and all our enemies cut off all our supplies during this war. Like we got to have some domestic manufacturing of things. And the South were the ones who would suffer from those tariffs. They actually were the ones who proposed, hey, we are going to propose these tariffs to make sure the North is protected, so we have some domestic manufacturing, right?
Exactly.
So what the correct level of that is, 10, 20, I think they proposed 20%, and then as time went on, for like all taxes, they go up, and then you reach this 30 to 40% range, and people are very unhappy, and then there's all this strife, and then they kind of, you walk that back, and it goes down, and then everybody's happy, and then boom, it goes back up again, and so that's what really happened after the War of 1812, and what kind of led up to the Civil War. It's a similar time now in the sense that we've got foreign enemies, but potentially, we're not saying for sure that they're an enemy, but there's frenemies, I guess. There's, conflicts and problems. And I don't want to live under a Chinese communist society. Yeah. Right?
Exactly. And so Triffin's dilemma created globalization, and it hollowed out the manufacturing base of America, which, for a while felt good getting cheap things from overseas, but then ultimately, hurt a lot of the people who were part of that manufacturing base, and more importantly, left us very strategically vulnerable. I mean, recently, Luke Roman's done a lot of work, and he's pointed out that, our defense industry relies enormously on rare earth metals that we get out of China.
Yeah, it's another choke point there.
And it leaves us at great risk. I mean, so if we get into a shooting war with China, I pray to God we won't. I don't think we will. But if we were to get into one, they're supplying things that we need for our own defense. That's a problem. Yeah. That's a fundamental problem. Yeah. So, there needs to be balance in trade. And the whole notion in Ricardo, David Ricardo was the one who set up the whole notion of free trade, which is to say that, if some country does something better than another country, they should do that exclusively, and the other country should do what they do well, and then you trade back and forth. You both get off rich. You're both richer. But if there's an imbalance there, then it should be settled by resetting the currency levels and or shipping gold back and forth to balance out so that no country can live beyond its means. What Bretton Woods did, and what creating the dollar, the dollar reserve currency standard did, was it gave the United States the ability, the exorbitant privilege to live beyond its means, which felt really good for a while. Yeah. But now it's come back to bite us in the ass. Yeah. Right?
And all good things must come to an end.
Exactly. And that's really, and I think that's why, Scott Bessent, the Treasury Secretary, has basically said, what he said in code is, we're blowing up Triffin's dilemma. This isn't working. We're going to go back to a neutral reserve currency. He's a gold guy. Yeah. But
Bitcoin
he understands
guy as well.
He's a Bitcoin guy as well. Exactly. Yeah. And so, so we formed a Bitcoin strategic reserve. I don't think that's an accident. I think they realize that these two neutral reserve currencies, gold and Bitcoin, are going to be a much more important thing in future trade.
Yeah. I think he's right. I think you're right.
I do too.
Here you wrote, about Paul Volcker. You said he's hailed as a hero by those who benefit from the fiat system. It is not a surprise that Volcker is hailed as a hero by today's fiat lords. I love some of the stuff you wrote. By today's fiat lords. What, I guess you wrote a lot of stuff in his memoirs, and you kind of describe him as a company man. What do you mean by that?
Well, he was a government employee for a large part of his life. He was also a banker at times, but the banks and the Federal Reserve are pretty tightly integrated. And and I say government employee, I mean a Federal Reserve employee, but effectively I think the Fed is part of the government. And so he realized he wanted to continue and perpetuate the system that now exists. And so, when Nixon was faced with the crisis he was faced with in 1971, that all the gold was being drained out of the country, the proper thing to do was to devalue the dollar in terms of gold.
Yeah.
And to leave the currency on either a domestic or an international gold standard. But that would have been painful. That would have caused inflation. It would have been disruptive. And, probably from Nixon's point of view, he feared that he wouldn't be able to get reelected. And so he said, well, find another solution. And Volcker came up with this, solution. Well, let's just tell them we're not going to give them gold anymore. Let's just break the link to gold. And so, he took an action that perpetuated their system, but was dishonest when it was a default. I mean, if you were a foreign country, you could say, hey, you screwed us. You gave us a deal. Now you're changing the deal. But more importantly, it took us away from sound money. And of course, we all know that it's sound money which provides human prosperity. And so, he led us into a road where America could kind of cheat, and we could continue to get all the benefits of being America without the true attendant costs. Although they showed up pretty quickly in terms of inflation.
Yeah, I mean, he did jack there was definitely some pain there for a lot of people, and I guess.
See, that's later. But what I'm talking about is actually in 71, when they went off the standard, Volcker was in the room. So he was the Undersystem Secretary of the Treasury. John Connolly was the Treasury Secretary. The guy who said the dollar is our currency, but it's your problem. so when
at least he's honest.
Yeah, at least he was honest. When we went off the gold standard, as you can imagine, a lot of countries were screaming bloody murder. Like, hey, what the hell? You guys
fucked us.
You screwed us. I mean, we thought we had this deal. We could,
Yeah.
And he went to I think it was a Club of Rome meeting in Italy, and he said. Yeah. The dollar is our currency, but it's your problem. Kind of like, screw you. You got to live with it.
Well, Larry, don't you know the golden rule? Those who have the gold make the rules.
Well, that's kind of true. Yeah, that's kind of true.
Which is what we did.
Which is what we did. Yeah. We had the reserve currency, so we made the rules. I'm not sure we had the gold, but
we had some gold, and they were draining it. So we decided to change the rules because we didn't want the real money drained.
That's exactly right. Yeah.
Oh man. So. Tell me about the London gold pool.
Yeah.
What is this? I didn't really. I'm not.
Leading up to 1971. So the U.S. with the Korean War, the U.S. started deficits. Not a lot, but we started deficit spending. And then Kennedy got elected. He was assassinated. Johnson started running the show, and he put in guns and butter. Right, he put in social programs like Medicare, and he amped up the Vietnam War. Both of those things were very costly.
Of course.
So foreign countries looking at this said, these guys are printing money to pay for these social programs. They're printing money to pay for this war.
Yeah.
I'm guessing those dollars aren't really worth $35 an ounce anymore. that price of the gold, that they don't have enough gold to support all those extra dollars they issued. And that's why they started asking for the gold back.
Yeah.
Well, so the U.S. said, okay, this isn't good. They're asking for their gold back. They don't trust us. We don't want to change our policies. Maybe we can just hide it. Maybe if gold price doesn't go up, nobody will know. And so all the central banks got together and they said, let's go to London. Every central bank, you guys throw in a bit of gold, and we'll every time somebody takes the price of gold above $35, we'll sell into the market to drive it down.
Wow.
And in the beginning, they were successful at doing it. So it was manipulation, right? Yeah. In the beginning, they were successful at doing it. The problem is the bid just kept coming.
Yeah.
and the deficits, and kind of like Lynn, and nothing stops this train.
Yeah.
The deficits got worse and worse, right? Vietnam spending kept ramping up, and so sure enough, the price, even though the official price of gold at the time was $35 an ounce, it was trading at $40, $50, $60 an ounce, which was a way of speculators realizing, hey, this official price is bullshit.
Yeah.
They've issued too many dollars. And so they had this pool to try and stop it. Well, the problem is the pool eventually got overrun.
Yeah.
They couldn't do it, and they disbanded it. And that was in 67. And then, 4 years later, America got overrun with like, hey, you guys are all asking for gold. We don't want to give it to you. We're going to default. So
yeah, calling us on our fraud. Right?
Yeah, exactly.
Oh man. Wow. Interesting. Very interesting. That's the beautiful thing about like hard monies like Bitcoin and gold is that, you can only, these are finite scarce resources and you can only suppress and play these funny money games for so long.
That's exactly right.
Until the system pops, right?
That's exactly right.
This takes us to the Clinton administration and the famous slogan of "It's the economy, stupid."
Yeah.
This is a funny quote from, I think this is Bill Clinton himself said, "You mean to tell me the success of the program in my reelection hinges on the Federal Reserve and a bunch of fucking bond traders?"
Yeah.
Oh man, that's classic.
Yeah, that was in Bob Woodward's book.
Yeah. Unpack that a little bit.
Well, so Clinton is president. And he's running for reelection, and the bond market had, I think, just had a spasm. I'm not completely sure I got my timing right, but I think I do. Mm-hmm. They realized that they needed to keep the money supply growing, and they needed to, remember, money supply growth and kind of inflation does keep the economy cooking and keeps it healthy. And what the government ideally wants is they want full employment and a healthy growing economy, but they want low reported inflation. Mm-hmm. And who calls them on the low reported inflation? The bond market.
Yeah.
Or the price of gold. Those two things. If the bond market, goes the wrong way and interest rates go up, or the price of gold goes the wrong way and the price of gold goes up, either one of those two things suggests to the market that there's inflation involved, and that's a problem. And so what Clinton was saying there was we got to figure out a way to hide the inflation.
You call these two things the canaries in the coal mine.
Exactly. And so we got to find a way to hide the inflation. And what they did was they put Robert Rubin in charge of manipulating the price of gold.
Wow.
And it worked brilliantly. Yeah. They kept the price of gold down during that period, and he got reelected.
I guess Larry Summers authored a paper titled Gibson's Paradox, the Gold Standard, that described how the gold price was the leading indicator of inflation. And if suppressed, markets would not think that inflation was present.
That's right.
So is Larry Summers like, what was his position? Gaslighter in chief? Or?
Yeah, pretty much. Yeah. At the time, he was an economist at Harvard.
Oh, no. I'm shocked.
Yeah, right. Well, he's an economic. He's still an economics professor there to this day.
Wow. This is the newest scheme, the Exchange Stabilization Fund, the ESF. Whenever you see an acronym of all these,
by the way, that was set up a long time ago, but it's grown in size over. I think that might have been set up in the 30s actually, but it's gotten much bigger, and it was used very aggressively at certain points in time to manipulate financial markets and to help benefit the U.S.
Yeah. And I think this, gold has a lot of issues, but this is probably one of the bigger ones, which is because gold is centralized and often unverified and unauditable, it's much easier to hide this funny business.
Oh,
right?
Absolutely.
As opposed to, with Bitcoin, which is this transparent public,
ledger.
Decentralized ledger, right?
Yeah,
it's
you can see where it is.
You can try to do these games, but it's much, much harder, right? Yes. Because everything is on chain. So I guess you have your friends who set up this, the counter organization, the Gold Antitrust Action Committee.
Yeah, these are good guys.
Did they get them?
Well, I think they have a website and they have all the documentation is there. I think they produced an unassailable case against the manipulators of the gold price. I think they found. A lot of these older documents have been released from the 60s and 70s, and there's just lots and lots of clues.
Isn't it crazy? Like you read all these documents are released 60 years later or whatever, and you're just like, holy fucking shit! Like the CIA, all the stuff
they killed Allende, and
just like the craziest things you can never.
Mogadishu. Everyone thinks Iran is all incredibly evil. Well, we helped the revolution, or we helped the people who overthrew the democratically elected leader. Right? And we put in the Shah.
Yeah.
And at the time, nobody knew it or nobody understood it, but there are lots of things the United States has done.
Then didn't we later get rid of the Shah?
Well,
we decided we were going to get rid of the Shah afterwards, or how?
We weren't really involved in getting rid of the Shah. The Shah was overthrown by Khomeini.
I thought Jimmy Carter had a hand in all that. He
might have. Yeah. The actual details are somewhat sketchy, but he lost control to the mullahs and Khomeini and the guys who followed him. But the point is that
we think we're God. We like to play God everywhere.
Well, that's exactly right.
We got rid of the democratically elected government, put in the Shah, and then when we didn't like him, we tried to get rid of him. And holy shit, look what we have now.
Right, exactly.
The worst of all the worlds, right?
Exactly. And so So, but the GATA guys were very good at documenting the gold price suppression. And there's just no doubt that it's taken place. And that's all to the benefit of fiat currency and the people who run the system.
Yeah. The Bank for International Settlements.
Yeah.
Tell me about this bank. I think
that's an evil organization.
If you read I think it's the Creature of Jekyll Island. If you read that book, they talk a lot about this. I think they talk about the BIS and they talk about all these world banks and and then all the fucking pernicious shit that's happening with it's like a money printer above the money printer, and then they just give it to corrupt, it's like literally funding like fucking total corruption everywhere.
Yeah,
you can't even make it up.
You can't. The BIS is the central bank of central banks. Every major country has a central bank pretty much today in the world, but they all coordinate amongst themselves at this organization that's headquartered in Switzerland called the Bank of International Settlements. And so, and by the way, I think this is used a lot within the fiat world to, one bank will stop printing money, but then another bank will start printing money. And so they take turns with respect to inflation. And the BIS, in the gold price suppression documents, you can see the footprints of the BIS very heavily. Yeah. All central banks share a mission, which is to support fiat.
It's a cartel. Yeah, it's literally what it is. It's like
they all want
to suppress.
They all want to support fiat, so they work together on that.
Yeah, you can even see the kind of workings of that against Bitcoin right now, where they're making these deals with El Salvador, for example, where we'll only help you if you stop talking about Bitcoin.
I know. What I love is that Metcalfe just yeah. He takes the money and then he buys more Bitcoin.
That's what they all fucking do anyway. They don't follow any of their own agreements and they lie about everything. It's crazy. Yeah. This brings us to a section where you talk a little bit about gold versus Bitcoin. What are your thoughts on that? There's this whole big debate. You think it's silly?
I do. I think it's silly. I think they're both forms of sound money. I think that there are legitimate reasons why some people want to own gold and should own gold versus Bitcoin.
Volatility, especially. I think
the volatility being probably the most major one. But I've said many times, I think Bitcoin is far superior, and Bitcoin is going to ultimately demonetize gold, but not tomorrow. It's going to it's going to take years. They're just two forms of sound money. One is analog and old fashioned. The other is digital and modern. And I think the digital is going to shove the analog down to a much, much smaller role, perhaps almost no role at some point in time. But
I think gold will always have a role. There's always
clearly
something about having a physical scarce metal.
Well, it's got jewelry value if nothing else.
Right? But it definitely will be demonetized and further.
The premium will continue. The premium will continue to come out of it, in my opinion, as the years roll by.
Yeah.
So be it. That's just the way it is, and this is the world that we live in. Look, people still have horses, right?
Of course. Yeah.
Horses are useful. They're pretty. They're they race.
Yeah. There you go.
And some people actually use them for useful purposes. I've seen them. I know places where their plow horses still being used.
Yep.
Right. Yep. But having said that, machinery has replaced the horse, and Bitcoin will replace gold.
So I think you have a sound money friend of yours who went all in. He swapped from. He was all in on gold, and then he went all in on Bitcoin once he understood it. He basically what he said was, look, gold is historically the soundest form of money, but governments have figured a workaround through the paper gold markets to suppress its price. With Bitcoin, the cryptography is so bulletproof that there is no workaround. I'm going to join the villagers over here who are storming the castle with technological torches and pitchforks. It is the only way we will win. I love that quote.
It's a great quote. He's a really smart guy. And when I heard it, I thought to myself, he's right.
Yeah.
And it's why I always say I love the fact that you guys showed up. It's like we got the reinforcements.
What's his name? Do you want to give him a shout out?
No, I can't give him a shout out. Well, I could, but he wants to stay private.
Oh, he wants to stay private. Okay. Yeah. All right. Well, tell him I said hi. Yeah. And tell him I love his sending this episode.
It's a great quote.
Gotcha. Okay. You want to talk a little bit about silver? You call it poor man's gold.
But it's really been demonetized, but it still is a form of money. It's got monetary qualities. It is scarce, not as scarce as gold. It's a bearer instrument, etc. It also has the nice advantage of being a really useful and needed metal. So I kind of consider it to be gold on steroids. It's a very small market. That's the other thing. The gold market is billions of dollars a year in just gold mined plus all the outstanding gold. The silver market, there's not a big governments aren't putting silver on their balance sheet. So there's not a big storehouse of silver out there. But it's actually very essential in certain areas, like in solar applications and some electrical applications. It's thought to be, it's going to be used heavily in these new solid state batteries that are being developed. And so what happens with silver is when it gets short, the price goes nuts. We've had 2 cases where the price went from $10 to $50, and in a very, very short period of time. And so those of us in the investment community and the precious metals investment community, we call it gold on steroids.
Yeah.
And I fully expect that in this next inflationary event, when the big print occurs, that gold is going to 5,000 and silver is probably going to 200.
Yeah.
It's at 33 right now. So.
Yeah, you have here, you say silver's relationship to gold is grounded in nature. I thought this was kind of cool to learn about that. 15 to 17 parts silver for every 1 part of gold, like within just
that's in the Earth's crust.
In the Earth's crust in nature, right? So that's a 15 to 17.
By the way, that always used to be the ratio between the two prices. But that's because silver's lost its monetary premium. It's changed.
It's gone to 81 to 1.
It's even higher. It's over 100 right now.
Oh my goodness!
Wow. Well, because gold's gone up and silver really hasn't moved.
Yeah. Wow.
And again, one of the things that dictates that, Matty, is that the stock to flow on silver.
Yeah, stock to flow is such an important. We're going to talk about that. Yeah, we talk about it right now. It's important. It's an important thing. Can you define that and explain stock to flow? Because when I understood stock to flow, it was like, oh, everything makes sense to me now, because it was like people would tell me like, well, platinum is more scarce than gold. Like there's less platinum that exists, right? But like,
there's not a big stock.
But I guess the stock to flow, if there was a huge demand for platinum, you could produce more of it, like, quickly. On demand very quickly, right? Yeah. So that was like, oh, okay, I get it, right?
So stock to flow, stock is the amount of an element that we have out there, and flow is the new amount of the same element that's been created every year. And the highest stock to flow ratio in the world right now is Bitcoin, because the supply of Bitcoin is only growing at 0.8%.
This last halving, I think, took us below gold historically.
Right. Gold is growing at about 1.7%. The last halving took us to a growth rate in the stock to flow in the flow of Bitcoin to 0.8%. And it's going to go to 0.4, and then it's going to go to 0.2, and then it's going to go to 0.1, as we all know, with every
0.05.
With every halving. And so we are asymptotically adding Bitcoin at slower and slower rates every 4 years. And gold pretty much for quite some time actually has just been kind of ticking along at 1.7% a year, plus or minus 1/10%. And that's because we have, we mine about 3,500 ounces a year of gold, or 3,500 tons per year of gold. And there are about 200,000 tons in existence above ground that we know of. I mean, some's been lost in shipwrecks, but most of it's either around a lady's neck or in a museum or in a bank vault. And so, with respect to silver, it's hard to tell what the stock to flow is, because do you count all the tea services that old ladies own? or don't you? But there's not a big stock of silver, and so the flow is higher relative to the stock, and also it's easier to add silver capacity, and so than it is to add gold capacity, because there's more of silver. There's more silver in the Earth's crust. So as a result of that lower stock to flow, it has a worse set of monetary characteristics.
Yeah. You mean higher stock to flow? Like
No, lower in the case. It's a lower stock to flow for silver. So a higher, stock to flow, take the stock, divide by the flow. In the case of gold, or in the case of Bitcoin, it's over 100, because you're adding 0.8 every year. So if you've got 100 Bitcoin, you're adding 0.8%. It's stock to flow there is 120, 130. In the case of gold, stock to flow is something like 50 or 60, whatever 100 divided by 1.7 is. Okay, it's actually below 50, a little over 50. In the case of silver, I think the stock of silver in the world, we add about 800 million ounces a year. And I think the stock outstanding, it depends on what you count, as I say, whether you count T-sets or not. But there's call it maybe, 1 to 2 to 3 trillion ounces of above ground silver sitting around. and we're mining 800 million a year. So the stock to flow ratio is much lower than gold and Bitcoin.
And that, that kind of like, if there's a price spike, there's an incentive to produce more. And if you're able to produce more quickly,
you'll do it. You'll do it. Exactly. And that's why in silver historically, we've had these big spikes, but then they come down off the spikes pretty hard too.
Yeah, because there's that incentive and the market is actually able to go and grab more. And with Bitcoin, that's impossible. You cannot increase that stock to flow. Right.
That's the beauty of it.
It's the beauty of it, right? We could talk about Bitcoin all day, but I think this is actually interesting. This idea of bimetallism. Do you want to talk a little bit about the history of that? Because I had heard about William Jennings Bryan, and it's got some kind of cool stories here.
Yeah, it's a long story. But throughout American history, there's been there was a battle between sound money and hard money. Even with, and of course there's a battle over fiat now, but way back in the day, before fiat was even the principal issue, there were the hard money people who believed in gold and the softer money people who believed in silver.
Yeah.
And this is why William Jennings Bryan had a presidential speech where he said, "Thou shalt not crucify mankind on the cross of gold," right? And actually, if you look at the Wizard of Oz, it was actually an allegory about the gold-silver battle. And the farmers and the people who allowed themselves to get into debt in the day, they actually wanted silver to be money because silver, there was more of it, and it was more inflationary, and it allowed debtors to get out from underneath their debts. And of course, the hard money people back then were the gold people, and they wanted gold to be the form of money. And so there were a lot of there was a big tussle over this issue for decades, really, whether we were going to have hard money or some as measured between gold and silver. But it all kind of fades into irrelevance because both of them have now become, analog forms of money and are not nearly as relevant as they were back in the day. But it was a big deal for 50 years. And, and the government, remember, the government in the Constitution said only gold and silver could be money. And there's a long history of, they set ratios between the two. And if the ratio was wrong, one of them disappeared from circulation because everyone hoarded the stronger one. I mean,
they melted it down or something like that.
Exactly. There's a lot of that's a story unto itself. But it's not nearly as relevant today as it used to be because the monetary metals have really become much less important in the monetary scheme of things.
The last section of this episode, we're going to talk a little bit about fine art and collectibles. What are your thoughts on those as holding value?
Well, they're great. I mean, the nice thing about fine art, particularly, wealthy families in Europe have used this for years. I mean, you figure you got to flee your country. It's hard to take $1 billion worth of gold. Yeah, it's pretty heavy. But if you've got a Renoir or a Monet, you roll it up and you put it in a tube and you walk out of the country and you got $20 million worth of value or whatever the heck it is. Now, it's a lot more than that today. You got hundreds of millions of value. So that's all great for the super rich. I mean, for the rest of us, I don't really think those are places to store your wealth.
Yeah. I've been investing in some art pieces by this new famous artist. I think his name is Hunter Biden. Have you heard of him?
Yeah, right. Well, that's the thing. I mean, and as we talked about earlier, value is subjective, right? And collectively, mankind, we've all decided that Monets are beautiful, Monets are rare, Monets are important, and so Monets sell for hundreds of millions of dollars a copy. But that's just a collective illusion. Yeah, I mean, it's a piece of canvas with paint on it.
But I think it points out something that is interesting, right? That we'll close this out and I'll read something from a quote that you have here. But people can value, not everything has to be money, right? People can value other things, and that's kind of what I tell people all the time. Is money is super important. It is very important, but it's not everything, right? No, not at all. There are people can value different things, and you wrote here as bare assets, they offer certain advantages, and if you genuinely enjoy beautiful things, their possession provides pleasure beyond monetary implications.
Absolutely, yeah. No, if you happen to like a piece of art, you may not care what you paid for it, and if other people like it as well, then someday they'll pay you more for it. But in the meantime, you get to look at it.
They are best suited for those who value the joy of ownership as much as monetary preservation. Right. So I think this is a good point to let off.
Sounds great.